New data shows outbound shipments increased 8.6% year-on-year, exceeding $300 billion US. But imports unexpectedly fell 2.3%, a further sign of weak domestic demand. China's money supply, that's the total of all currency and other liquid assets, grew 6.2% year-on-year in June, narrowly falling short of the forecasts, while $1.8 trillion of new loans were issued in the first half of this year, part of efforts to try to bolster the economy. David Mahon is the executive chairman of Mahon China Investment Management.
The fallacy in the West is that trade sanctions, initiated by Trump and continued by Biden, would make a difference to the growth of China. It's not. It's galvanized China to focus on a leading edge in terms of not just growth in terms of exports, but in terms of the internal consumption story. Post the crisis of the Chinese government challenging real estate, trying to break the cartels in real estate, there was a massive slump after the end of COVID. But the technology sector is now 40% of GDP growth. And it is kind of combining a 10-year strategy, which is China wants to be a high-end tech supplier to the world. And now we're finding a point where the West has missed the whole focus, which is that the focus of Chinese economy is not just exports, but 40% of GDP growth is tech and high tech. So instead of being passive recipient of trends, they're setting trends, which has been exemplified in EVs, solar panels, windmills. China's now beginning to set where demand lies in the West, and we're about to go into a new phase of a revolution in the Chinese economy, which is exports to the things that the West can't make itself and depends upon for China. And you're seeing the beginnings of this in these statistics.
David, I just want to ask you about timing, because we know we're approaching the midnight hour on these impending higher tariffs from the United States, and the EU come to that. I mean, how much has that influenced the timing of imports, and what has been the effect on China's export figures? Can we break it down?
We can break it down to the fact that when you base tariffs, as the US has done, on security interests, it's random. It's not to the core of what China makes. So it doesn't really matter. I mean, the rise of China, which has been either decided from the commentariat from the late 80s, early 90s into the century, is that China's becoming factory of the world, then the initiator of technology, creating new essential technology for global consumption. I don't think that there's any force from Europe or America that can change the fact that the paradigm has shifted. China will now define what will be made in demand. Look at Apple. Apple's built businesses in India, but 90% of what it does is still in China, based on supply chains. In some ways, supply chains have moved offshore, Vietnam, Mexico, but 70, 80% are still the structures, supply chains within China. So we're moving into a new paradigm globally where China begins to actually make their money and define what are the products that people will buy.